With so many investment options out there today, why do investors keep coming back to fixed income? Three common reasons are predictability, diversification, and choice. Predictability. Investors like fixed income securities because they pay out interest on a set schedule. It works like this. You loan money to a government or corporation through a fixed income security, like a bond, and in return, you receive regular interest payments. Depending on the product, these may be paid monthly, quarterly, semi-annually, annually, or just once on the maturity date. You can use those earnings right away or reinvest them to keep your portfolio growing. Once the product matures, you also get back your initial investment. Because of their lower risk profile in comparison to equities, fixed income products have a reputation for being more suitable investment vehicles for retirement age investors. However, younger investors are turning to fixed income more and more for long-term financial planning. With the rise of the gig economy, workers are earning money outside the traditional 9-to-5 structure. Some are using fixed income as an opportunity to earn an additional source of revenue. But outside the full-time model, workers don't have the same access to company pension funds and health benefits. This is why younger investors are also seeing fixed income as an opportunity to steadily grow a nest egg while minimizing losses to their capital. Which brings us to diversification. Fixed income products are on the lower spectrum of risk in the overall offering of securities. They come with relatively low returns, but they also carry relatively low risk compared to equities. When equities do well, they can do really well, but they can also depreciate by a lot. Fixed income products tend to be much less volatile. If you hold both equities and fixed income products in your portfolio, the steady nature of fixed income returns may help balance out some of the heavier equity losses and keep your portfolio healthy in the long run. That's because when you incur a loss, the gains you earn back need to be greater than what you lost in order for you to break even. Think of it this way. You start with $100. You lose 10%, so now you're down to 90. What happens when you earn back 10% of 90? You're only back to 99. You actually need to gain 11% of your remaining investment just to break even. In fact, the higher your losses, the higher your gains need to be. A 20% loss requires a 25% return to break even. A 30% loss requires a 43% return to break even. By the time we get to 50%, you need to make a 100% return just to get back to your starting point. However, having a well-diversified portfolio that includes fixed income products may help you limit those losses so that you can actually stand to gain more in the long run. To put this into perspective, a hypothetical $100 portfolio that loses 30% in a drawdown and gains 50% in the subsequent rise would only stand to gain $5. Whereas if it loses only 10% in the drawdown, it would gain $35 in the subsequent rise. The third reason investors keep coming back to fixed income is choice. From treasury bills to guaranteed investment certificates to bonds and beyond, investors are spoiled for choice when it comes to fixed income investing options. Depending on inflation, interest rates, and your risk appetite, you can choose between short-term and long, government and corporate, more and less frequent interest payments. And if investing in individual products sounds like too much work, many investors reduce their workload and spread their risk by buying fixed income mutual funds or exchange-traded funds. Mutual funds and exchange-traded funds, or ETFs, are like baskets that contain a collection of securities chosen by a fund manager for a fee. So, the work of diversifying is done for you. While some investors choose to invest exclusively in funds, others use them as part of a wider income-generating portfolio. Whatever your financial goals, fixed income is a key component of any well-diversified portfolio. Have more questions about fixed income investing? See our schedule of upcoming webinars and masterclasses for instructor-led content and live insights from industry guest speakers.